Hey, what's up, my friend? So in today's training, I want to share with you pullback trading. And there are many of you, right, who trade pullback and is making one of these mistakes. And that probably lead to you, trading pullback and then suffering a series of losses. You're trading pullback but not getting the results that you want. You're trading pullback but somehow your losses is always larger than your gains. What is going on, Rayner? Well, that's because you're probably making one of these mistakes. Number one, you only wait at support and resistance. What do I mean by this? So let me give you an example. So let's say this is a chart of Aussie against the Swiss franc, and you can see that this market is in a downtrend, right? Lower highs, lower lows. So what many traders will do is they will plot their level over here, somewhere about here. Okay, you can see that over here, price previously was support, then it broke down. Now support is likely to become resistance, and they wait at that area, at this area. Now what's the problem with this? Well, if this is the only area that you're looking to short the market, then you're missing a lot of trading opportunities. Because the market might not retest this level. It might just make a pullback, and then the pullback ends and continue lower. And when that happens, you're watching on the sidelines, man, not another move that I missed, another wasted opportunity. I should have known it, I should have chased the market, entered the market, blah blah blah. Why is that? Well, that's because you only know how to identify one area of value, and that's support and resistance. And there's more to it, which I'll explain later. Okay, so this is a mistake, right, that many traders make, right, is that they only wait at support and resistance. And that's not how pullback trading is meant to be. There are other areas of value, right, to trade from, which I'll share more later. So let me give you another example. If you look at this chart, another uptrending market, right, this is the 10-year Treasury note futures, and again, traders, they look at this chart, they know that it's in an uptrend. And Rayner is a trend trader. He say when the market is in an uptrend, we look to buy. And where do they look to buy? Again, they only look at one specific area of value, which is support, 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 support. And now, let me ask you, how many times did the price retest this area of support, retest this area of support, retest this area of support, retest this area of support? Based on the chart that we are looking at right now, you can see that this market wouldn't give you an opportunity, right, to buy at support. You won't have the opportunity to buy at support. You won't have the opportunity to buy at support. So this should really, right, make you think that, man, when I want to trade pullback, it is more than just support resistance. And I'll share with you later what else, right, you should be looking at. So that's the first mistake many traders make, is that they only wait at support and resistance. And they wait, and wait, and wait. And by the time the price comes to support resistance, that's where the pullback ends, is the reversal, and they get stopped out of the trade. Okay, so I'm not sure if any of you have experienced that. If you have experienced what I just mentioned, leave a comment below and say, me too, I feel you. Mistake number two, you enter your trades too early. That's another one, right? You time the pullback. Oh, the market is coming to my pullback area. And then next thing you know, you buy, the market collapses lower. What's going on, right? That's because you buy or you enter your trades too early. So let me give you another example. Okay, for this one over here, you can see dollar Canadian. Okay, look how bullish this market is. Right, you can see that market broke out of this resistance, break out, makes a pullback, and next candle over here, the most recent candle, the market has closed higher for the day. And at this point, right, traders who miss the trade, they are anxious to get it. Oh, the pullback is coming to an end. Let me buy. And when they buy at this price, they wonder why they get stopped out of the trade. Why is that? I'll explain to you why shortly. But this is a mistake that traders make when they trade pullback. They enter their trades too early. Another one, pound yen. If you see over here, same thing. The market pretty much broke below this area of support. Strong bearish momentum. Then we have a couple of candles, pullback here. And this candle, at one point in time, if you imagine this candle was actually trading near the lows over here. It was actually pretty bullish. The lows, right, the closing price was actually near the lows of this candle. I mean, before the market closed, it was a red bearish candle. And many traders, they get excited. Oh man, the pullback is coming to an end, right? Look at how red this candle is. It's time to short. Then they go short, they sell. What happened? Well, they entered their trades too early and they got stopped out again. Okay, so that's the second mistake traders make, is that they enter their trades too early when they are trading pullback. And now this brings me to my next point. How should I trade pullback? Alright, Rayner, I know. I can't just focus on support resistance. I mustn't enter my trades too early. So how do I do it, Rayner? How? Well, that's what you're about to discover right now. So the key thing that you must know, right, when you're trading pullback is you must pay attention to the market structure. Now, I can't give you a full lesson on market structure, so we will just talk about market structure in a trending market. So here's the thing, right? Not all trends are created equal. Some markets are in a strong trending behavior, some are in a healthy trend, and some is in a weak trend. So let me point out to you the subtle difference. In a strong trend, the price tends to stay above the 20 MA in an uptrend. And in a strong downtrend, the price tends to stay below the 20 MA. In a healthy trend, the price tends to pull back or retrace towards the 50-period moving average. And in such a healthy trend, the market also has a tendency to retest previous resistance that could become support, and vice versa for a downtrend. And finally, a weak trend. This is the weakest of them all. This is where the pullback is usually very steep, very deep, right? It tends to find support resistance at the 200 MA or at previous support resistance area, right? I know this is a little bit of a theory, so let's look at some examples, right, to kind of illustrate these points that I just shared with you. Because once you understand this, right, trust me, you will never look at pullback trading the same way again once you understand this trending market structure. So first one, let's have a look at this one over here. Aussie Swiss franc. Remember earlier, right? Many traders, if you look, you just zoom out, they are waiting at this previous support that could become resistance. But now, if you understand market structure, you would know that that is not the only area of value to trade from, because you can also trade from other type of area of value. For example, the 20 MA. Why the 20 MA? Because if you look at this market, this trending market structure, the market right now is in a strong downtrend. It's consistently below the 20 MA, below the 20 MA, and still below the 20 MA. Tested once, twice, and thrice. Okay? So at this point, I won't be looking to sell at this area of resistance. I will be looking at this 20 MA for trading opportunities. The market has given me clues that it has respected the 20 MA. It tested once, twice, and right now it's at this area once again. Okay, so now the 20 MA is a key area that I'll be looking for to trade the pullback. And how can I trade the pullback? So let me give you a couple of ideas to trade the pullback. Number one, what you can do is you can look for a bearish price rejection at the 20 MA. This could be in the form of a shooting star, a bearish engulfing pattern. For example, market breaks out higher, okay, breaks out higher, and then suddenly reverse near the lows and close lower for the day. So this looks something like a bearish candle like this, okay, and you have a long wick sticking out. Right, this is a form of price rejection, and that's one way to time the market, because this tells you that the buyers have difficulty pushing the price higher and the sellers came in to control and close the price near the lows of the day. When that happens, you can look to sell on the next candle open. Stop loss can go above this candle high. That's one approach. Another approach, right, which is what I really like, is what I call the break of structure technique. So if you go down to a lower time frame, like the 2-hour time frame, you see that right now the price, right, is still being controlled by the buyers. How do I know that? Well, you can see a series of higher lows and higher highs. Right now at this point, it's still forming a series of higher highs and higher lows. So I don't want to short the market just yet because the buyers are still in control. But one thing that I do know is that on the higher time frame, the daily time frame, as we've seen earlier, the trend is towards the downside. And we've seen earlier that the price is also at this area of value, which is the 20 MA. So what I can do is that on the 2-hour time frame, I can use this time frame as an entry trigger to short the market. And the entry trigger could be as simple as, a break of structure where the price makes a series of lower highs and lower low. So one possibility is that the market could head down lower, okay, then it bounce up higher. And now, if the price were to break below these lows, right, this area of support, I would now have a series of lower high and lower low. This tells me that the sellers are about to come in to push the price lower. And on the higher time frame, you've seen that we are in a downtrend. So this can serve as an entry trigger to short this market, to time the pullback. Does it make sense? Okay, so hopefully this one, right, is clear for you to trade in a strong trending market. What about a healthy trend? If you look at this again, this market, again, if traders, again, they were to wait at, support, right? They probably wouldn't find too many trades because the market didn't retest those previous areas of support. So now, how can we trade this market? First and foremost, you want to ask yourself, what is the current market structure? I know it's in an uptrend, right? It's an uptrend, Rayner. Duh, it's an uptrend. But let's get more specific. What type of uptrend is it? What is the current trending market structure? And if you've seen earlier, I shared with you 3 types: strong, healthy, and weak. So which is it? One way to find out is let the MA be your guide, and if you just pull out the 50 MA, you realize that this market tends to respect the 50 period moving average. Okay, the depth of the pullback is steeper than what you've seen earlier on Aussie Swiss franc. So it tested once, twice, thrice, 4 times. So if you ask me, there's a good chance this market could find buying pressure at this moving average, at this 50 period moving average. And also, if you recall, I mentioned earlier that for a healthy trend, you can also find trading opportunities at previous resistance turn support. And if you look back at this chart again, you realize that in a healthy trend, previous resistance, which is here, resistance that could now become support. So right now, if I want to buy, if I want to trade this pullback, I will be looking at this area around the 19645 area. Again, entry trigger, very simple. We can look for a bullish price rejection, like a hammer, or we can look for a break of structure on the lower time frame, either on a 2 or 4 hour time frame, to time out entry and to trade this pullback. Does it make sense? Another one, right? Let's look at this market structure now. Gold. If you look at this market structure of gold, what is it? Is it a strong trend, a healthy trend, or a weak trend? Again, if you look at things, right, just zoom out a little, to me, I would classify this as a weak trend because the historical pullback has been pretty steep. This one is pretty steep. So for a weak trend, again, where is our area of value? Well, it's not going to be at the 20 MA, it's not going to be at the 50 MA. That's for sure. Where you're looking for trading opportunities will be at support resistance area. So this is a wick up trend. So I'm looking for buying opportunities at this area of support. And sometimes, right, in a weak trend, you can also find that the market respects the 200 MA. So let's see whether the 200 MA holds up here. Okay, you can see they tested pretty much, I'll consider this 1 time, 2 times. Okay, so again, around the 200 MA area, around this area of support is where I'll be looking for buying opportunity. I won't be, using my tool like the 20 MA. Doesn't really make sense, right? I won't be using the 50 MA because clearly this market don't really respect this 2 moving average. So you have to understand, right, the market structure. Once you do, then you know which are the areas of value to look for trading opportunities. Make sense? So let me just walk you through the couple of entry triggers again, because I think that is important as well when you're trading pullback. So first and foremost, right, the first entry trigger that I mentioned earlier is that you can look for a bullish price rejection for an uptrend. So let's say the market hits down lower, 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 and then it forms something like a hammer over here. This is a bullish signal, right? It's telling you that the buyers are stepping in, right, and willing to push the price higher. The buyers are possibly in control. So this is what I call a false break, where the price breaks below this area of support only to close back higher above support, right? If that's the case, right, you can go long on the next candle open, right? Stop loss will go below this lows over here. Okay, that's one way. The other way is what I call the break of structure. So you go down to a lower time frame and look for a break of structure. So let's say we go down to the 4 hour time frame. You can imagine, right? Just imagine this. If the market were to retrace down lower to this area of support that we saw on the daily time frame, it would look something like this, a series of lower highs and lower lows. Probably something along those lines. So when you look for a break of structure, you want the market to invalidate this market structure. You want the market to invalidate this series of lower highs and lower lows. So what are you looking for? Well, you're looking for a series of higher highs and higher lows. And there are many variations to it. It could be something like an inverse head and shoulders pattern. It could be an ascending triangle pattern. There are all possible variations. It could be something like this. Then it starts to consolidate here. And this is your neckline, your resistance. And if the price breaks out, you now have a series of higher high and higher low. That's one variation of it. Looking something like an inverse head and shoulders pattern. Or it could also be like a ascending triangle pattern like this. If the price breaks above this resistance, now you have a series of higher high and higher low. So you can see that really the concept is what matters that I'm sharing over here. Not specific patterns, not specific, technical analysis. No, it's really the concept that I'm sharing over here. Okay, I hope that makes sense. So with that said, let's move on, right? So we talk about market structure, and just one bonus tip for you, or 2 bonus tips. Number 1, market structure is always changing. So I know many of you, after you study this video, start finding out, where is the strong trending market, right? Where is the healthy trend? Where is the weak trend, right? Let me find all this, patterns in the market. But trading is not that easy, right? In reality, when you're trading this in real time, market structure, they evolve over time. They change. Let me give you an example of what I mean by that. So if you look at this one, gold over here, okay? We look at gold. You can see that at this point, gold is actually in a strong uptrend, right? Price is above the 20 MA. and holding above it consistently. Then it broke below the 20 MA, started chopping up and down, breakout, then to where we are right now. So you can see that at one point in time, which is at this point in time, market structure is in a strong uptrend. Then it changed, it evolved to the weak uptrend that we've seen earlier. So the key here, really, the key here as a professional trader is that you must always anticipate, right, what the market could possibly do. So at this point, right, from let's say I'm trading this in real time, I would tell myself, right, if right now the market were to break below the 20 MA, if it's going to invalidate this 20 MA, I would shift my thinking, right? I would say that, okay, this market is now no longer in a strong uptrend. What are the possibilities? Well, maybe it's going to be moving into a healthy trend, maybe into a weak trend, maybe it would start to range. So where is the next area of value? That's my thought process. And I would say, okay, the next area of value could possibly be at this area of resistance, previous resistance becomes support, or at this area of resistance as well. Or maybe the market could form new price structure as what you've seen earlier. The market actually what it did is that it swings up, forms a new low and swings up once again. So now we have a new price structure, or in fact rather it's actually the previous structure that we had over here. So you can see that these are the thought process that I'm going to have. So the key thing to take note, right, the bonus tips that I have for you is that, number one, market structure is always changing. You have to be prepared for it. And number two, once you know that market structure is changing, right, you want to start identifying multiple areas of value the market might react to. Let me give you another example. So if you look at this one over here, we talked about Aussie Swiss franc earlier. Okay, so now this is my thought process. Okay, if the price were to break out of this 20 MA, it's going to invalidate this 20 MA. Where is the next area of value on this chart? That is the question that's on my head right now. Right? It doesn't mean that right now this market is in a strong trend. It's going to be in a strong trend forever. No, it could transit into a healthy trend, could be moving into a weak trend. So if this 20 MA, if it gets invalidated, if it gets destroyed by the market, my next area of value would be over here. I would start waving at this area. That's one possibility. At the same time, I know that this market could possibly also form new price structure for me to trade off. Maybe the market could break out, reverse down lower, and then now this, right, becomes a new price structure that I could trade off. Maybe it could come back up higher, and this will be the new price structure that I should be paying attention to. So can you see that as a pullback trader, as a professional price action trader, you have to be anticipating all this even before it occurs. You can't just be having, one specific setup, one area of value, pray and hope the market comes to my area, and it doesn't come, that's it, game over. It doesn't work that way. You got to think, right, 1-2 steps ahead. And hopefully by today's training, right, I have prepared you for that. And again, focus on the concepts. Don't focus on whatever, specific techniques, patterns or whatsoever. It is the concepts that matter. So don't ask me questions like, oh Rayner, can I use the 21 MA? Don't use the 50. Can I use the 52 MA? I will, that would really hurt my feelings, right? Focus on the concepts, right? Not the specific parameters or whatsoever. If you want to use the 20.5 MA, go ahead. Doesn't really make much of a difference. If you want to use the 57.8 MA, go ahead. Doesn't make much of a difference. The concept is what matters. So quick recap. Number one, the market can pull back to SR, moving average, trend line, etc. Don't enter your pullback trades too early, right? Let the price come to your area of value. Understand market structure, whether it's in a strong trend, a healthy trend, or a weak trend. In a strong trend, the market tends to respect the 20 MA. In a healthy trade, it tends to respect the 50 MA. And in a weak trend, it tends to respect the 200 MA. And in different market structure, right, you can find trading opportunities, like for example, healthy trend could be at a 50 MA, it could be at previous support and resistance. In a weak trend, it could be at support and resistance, etc. And finally, right, what's important is that you must identify multiple areas of value, right? Because market structure is always changing, right? Don't be so fixated on just this one area, right? Look at, multiple areas of value, such that if one area of value gets invalidated, if the market breaks out of it, right, you know where else, right, to camp for, right, for trading opportunities. Okay, I hope that makes sense. So with that said, I've come towards the end of today's trading. If you've enjoyed it, right, then I highly recommend you go down to my website, tradingwithrayner.com. Scroll down, and this guide over here would really complement, right, what you've just learned, right? The ultimate guide to price action trading. We talk about entries, exits, right, better timing, your entries in the market, support, resistance, and much more. So go ahead, download this guide, click this orange button, I'll send it to your email address for free. And with that said, I wish you good luck and good trading. Until next time.